off.
Okay, we're going to be on my Facebook page here in a second, so.
Oh, I'll be quiet.
Okay. All right, I want to say good morning to everyone. I'm Carrie Sparks with Pioneer Title. Happy Tuesday. I have to get my calendar out nowadays to make sure I know what day it is. But just want to welcome you to our class. It's going to be a series called Ask the Underwriter with Brian Reeve of Barrett Financial. I'm a business development officer, sales strategist in Arizona, representing what I believe is the best title company out there, Pioneer. We have nearly 90 offices across all of Arizona. So we are always blessed to work with so many wonderful realtors and loan officers. And as part of what we do is we work very hard to provide solid, really good education to the real estate community, as well as to the community at large. And if you are not working with someone at Pioneer and would like some sales and marketing support, please always reach out to me, give me a call. I'd love to be your partner in the business. I'll put all my information below after we're done. We're not recording this. We really want people to jump on a consistent basis, but since it is Facebook Live, you can go back and look at it after the fact. But just a little bit about Brian. Brian and I met now a couple years ago, and amongst a sea of people that I know that are wonderful in the lending industry, he's knocked it out of the park with some of the scenarios that he's put in front of me. And his history in the lending business is rich. It's multifaceted and just really quite an asset to have as a friend as well as a customer. So Brian, could you give your licensing information for a second, and then just tell us a little bit about your history in lending, just to kind of set up exactly who everyone's listening to.
Sure. My licensing is, my NMLS number is 694300. Work for Barrett Financial as a loan originator. Been on the loan origination side for about 2 years now. I started in the business in '96 with Norwest before they became Wells Fargo. I started as an MLO in Fort Huachuca, Sierra Vista area, doing pretty much VA manufactured homes. That's how I cut my teeth. Relocated at that point to the Phoenix metropolitan area. Changed over to operations after about a year of working for a broker in the Phoenix area. Became a processor, worked my way up to the chains, senior team lead, then became a team manager, and then senior operations manager for a lot of the major banks. I won't name which ones, but pretty much all of the major banks I work for as a senior operations manager over underwriting and processing and closing. So my experience stretches not only to just originating, but also closing, underwriting, processing, all of that. I work for the major home builders, also as a senior operations manager. I also used to do secondary marketing for, and that's basically hedging and reserving money from wholesale lines. I used to do that for a major home builder, Fortune 500 home builder for a couple of years, and then was a senior operations manager for a home builder for a couple of years. So I know the builder business very, very well. I think my experience encompassed probably about 10 years in the builder environment. Been doing lending for about 25 years. 10 years of those were all underwriting related. So basically, I'm a government underwriter also. So it's kind of, I just went through the ranks of working my way up from being a conventional underwriter, going the other way, doing FHA, VA, USDA, just working up from there. And then I decided about 2 years ago that it would probably be better for me to go back into origination, and it's paid off really well for me because it's allowed me to put things together and help customers that otherwise wouldn't be able to get financing or help getting into a home.
You and I talk several times a week, and kind of just prepping for these conversations, I think it's important to go over maybe some of the top things since the whole outbreak has happened in the country. What are some of the changes maybe when it comes to the underwriting process that you've experienced, as well as, if you want to give a little information on what the market's doing right now, maybe start with that.
So there's two things in lending that run parallel, which is a lot of people have in their mind that, well, all the underwriters are doing this. All of the government's making changes. Everything, the sky is kind of falling. What a lot of people don't realize is that lenders have a base model in which they employ guidelines. And these are released by Fannie, Freddie, HUD, the Veterans Administration, USDA. All of these base model guidelines are set. Now, what happens is these banks still have to find somebody to purchase their mortgage-backed securities or package them up and sell them in the secondary market. So through channels, through secondary marketing, or what we call, credit risk, they negotiate overlays that every lender or every policy that they should enact. So sometimes you'll see something where you're talking to a bank and they're just like, well, what do you mean you got to have 20% down, 700 FICOs? The sky is falling. That is that bank's strategy in order to ensure the types of loans that they're doing so they can align better with their investors. And these are called overlays. So I've seen quite a hiccup the last, I would say, 90 days. One of the main reasons is rates have slowly trickled themselves down to the certain point of where people were getting 2.75, 3.125. These were the kind of rates that we were standardly seeing. Well, in addition to that, with a lot of other things, I'm only going to briefly skim the surface because it gets pretty complicated because there's a lot of things that run parallel with this. But what happened is a lot of the investors in the secondary market that invest in mortgage-backed security pools, they've seen their existing portfolios getting ready to get paid off. Not only that, but there was a large influx of loans coming into the pipeline at 2.75, 3.125. So then what happened is that caused a sell-off in the secondary market of these portfolios. So this was the very first part of the retraction we started to see. When that happened, you have two people that are paid. You have the person that actually buys the asset that is paid the money, and then you have basically the person who services the loan that receives money or a service release premium on it. And that's usually about 150 basis points for that. And because of what was happening, there was a huge margin calls from the servicers. And because there was a huge margin call from the servicers, that created a little retraction for buyers and servicing in the secondary market. And then you added COVID to that, which that changed everything substantially.
Okay.
So one of the things that did when that changed is we had a situation where we had, market analysts looking at unemployment. We had a stimulus come out. The thing that really kind of hiccuped everybody with the stimulus is that at first the knee-jerk reaction was because they didn't have anybody to buy these loans in the secondary market with mortgage-backed securities, the federal government came out and offered a stimulus. And the stimulus was going to be a twofold. It was going to basically allow them to basically be the purchasers of mortgage-backed securities. So that's why they put so much, or they infused so much into it. And then what they did is they reduced the Fed rate. Well, a lot of customers think that the Fed rate has a great indication of what mortgage interest rates are. So everybody's like, wait a minute, interest rates are going to be 0% because the Fed rate dropped it down to 1/4. Well, that is the money that banks typically will borrow at the window from the Fed for operating expenses. So the reason for the Fed rate cut was basically to alleviate some pressure on the banks for short-term financing that they had to basically resell these loans in the secondary market, mortgage-backed securities.
Are you seeing that change now as we've gone through further into this pandemic? Are you seeing it loosen up a little bit? Are
It's
you
actually
seeing it
starting to
change?
it's actually starting to stabilize out a little bit, because what happened is when that happened, there was a huge knee-jerk reaction in rates. Rates went the other way, and they went up quite a bit, because what happened is everybody was worried that when the stimulus came out, they were also starting to talk about forbearance. Well, what happens is when you do forbearance, a forbearance basically that was put in place was a call to action, which is basically, hey, we want you to work with current loan servicers. And the thing that initially scared everybody is that when you have early payment defaults on government loans, the servicer, that loan becomes uninsurable. The servicer is still required to make the mortgage payment to the asset holder. So that was one of the reasons for the huge margin calls, is because they wanted to basically say, hey, look, our portfolio is going to kind of go sideways. So I'm going to stop right there and not elaborate too much on that. But what has happened now since then is, through the CARES Act, that call to action was basically to find a way to infuse funding for these servicers, and is only pretty much a call to primary residences. So what happened is in what we call the non-QM space, loans that are typically like the bank statement loans, the no income, the stated type loans, bank statement loans, all of these loans. A lot of these do not fall into what we call TRID or Dodd-Frank QM type loans. So this call to action was primarily for principal residences only.
Well, let me give you kind of a scenario just to kind of walk through maybe the average buyer right now, or the average person. So what would you say that you see what is an average normal credit score on that you kind of see come in on your application, rounded about?
So right now we're starting to see a divide between customers. Now that everything's starting to get stabilized out a little bit, what we're seeing conventional customers still getting good rates. If you have pretty much north of 700, you're still seeing in, high threes, mid threes, conventional rates with 5% down. The loans that are taking more of a hit and more of a retraction are the loans that are on the lower end, FHA, FICOs, pretty much everything less than a 660 most likely will run FHA. But you're maxed at, 331. So those are the ones that we're seeing more retraction in. We're seeing a lot of customers on the lower end of the spectrum with FHA financing, where a lot of lenders are placing overlays or pricing themselves to a certain point where it's just not competitive. So those 2.75s, 3.125s we were seeing on FHAs are now going to 4.5 that are on FHAs.
But they're getting a mortgage. They're still getting a mortgage. It's just maybe not what they would have had if we wound back time 60 to 90 days.
Correct. Well,
so if you got a credit application in for the purchase of a home, and they had a 640 credit score, it sounds like you're going to run that FHA. But kind of walk through some of the process right now. And I mean, you and I have talked about everything from, maybe they have to do a credit rescore, how that works, the appraisal process because of people not wanting to have folks come into, houses right now. Talk to me a little bit about, what's the home buyer nowadays going through an FHA? What are they expecting? Because it sounds to me like if they've got the down payment to go FHA, they're still getting into a house.
So to tag into what I was saying a little bit previously, FHA's guidelines and what is released from HUD is basically the minimum FICO score is a 500.
Okay.
And you can go 500 to 580 with a 10% down. Over 580 and above, you can do 3.5% down. So a lot of these loans that we had 620s, 596s, we could get approved as long as we have what we call as a total scorecard approval that we run through automation. Now, the overlays that have been in place, most everybody moved to 660. There are a couple of lenders that are still doing it at 640. But even though we get them at 640, we got to really be careful the lenders that we place it with, because we are held to what we call a safe harbor, or what we call as a qualified mortgage, where it's not a high price mortgage. So when that happens, we still are seeing tight retraction. So basically 640 is like the new 500 is basically what's happening for FHAs. So if we have a customer that's down in that space, it's getting tight. Where we primarily want to see for FHAs is, north of 660 is basically where we're looking at right now for financing. Investment, a lot of those lenders have dialed back because of the forbearance. They don't want to use the income from the property because in fears that forbearance is going to carry over to renters also. So there's a lot of moving parts, and it's based on the lender and who you use and at the given time.
Because you're a broker, so you can move things around more than like a retail lender, or
correct. So
explain that.
Typically we have 3 different types of lenders. We have a bank, which is going to be your major banks. They basically hedge and they get their money off wholesale lines, and they basically resell the mortgage off in 6 months. And then you have what you call as a correspondent lender. Correspondent lender are going to be your larger banks. I'm not going to name any names, but they're going to have a bunch of net branches. And they basically do almost the same thing on a correspondent line. And they may say that they're a broker, but they may only broker out a couple of products that they don't do. The thing is when that retraction happens to their one product set. So if the bank chooses to place an overlay, then all of their customers are going to get affected. If you're a correspondent lender and that bank chooses to place an overlay because of their hedging, all of your customers are going to be affected. With a broker, we have the ability to shop all of those individuals. So when we see one of the 100 retract, we just ship to a different one. So basically, we're able to narrow down who's willing to be the most flexible from a lender perspective because we're shopping the whole field versus this is what we're up against.
Well, let's go back to the scenario. Let's just say that there's this couple that's going through the FHA process and they qualify for the 3.5% down. They submit an application to you. Let's just say the rates are really great today and they say, you know what, Brian, I want to lock. Can they do that? Because I've heard that some places are waiting to allow for like locking and talk to me about the paperwork. And I've also heard from conversations with you about verifying employment right up to the moment, right before they close now, which is totally different than things that have been done in the past.
Okay, so let me try to run through that as briefly as possible without going too much on a tirade. The way that hedging works and the way that pricing works when a bank is placing it together is not, they don't make the money based on when the loan was locked. They make the money based on the time frame of what the rates are at the given point when they sell that loan off. So when they lock your loan in, it's basically a gamble on whether they're going to be in the negative or the positive when they sell that loan off. That was one of the reasons why the knee-jerk reaction to the market with all of these changes and immediate rate changes within hours in point swings is because they were worried about loans being locked and where they would be sitting from a hedging perspective when they sell that loan off. So some of the banks are not on the same page in this. Some of the banks, in order to remain competitively to reduce hedging expenses, have basically had customers hold off to lock a loan until the loan is approved. That way they're not hedging for the money and it's a viable loan and it's approvable versus letting anybody lock in a loan at time of registration and then they're in a worse position come time of the sell-off because they still had to hedge for that money. So one delineation of lenders is basically stating we're not going to let you lock until the loan is approved so they can remain more competitive in pricing. You have other lenders that have already built in what we call 60-day pricing because of the COVID and all of that, that they're basically just moving their hedging 60 days. So you can only lock it 60 days up front. So there's a lot moving on there. Now, when we talk about the virus, there's some lenders that are basically requiring verifications of employment the day of funding, disclosures from the customer stating that they haven't been furloughed, they haven't been laid off from work. They're basically verifying the legitimacy of their income up to the day of funding. It's not, hey, you got me approved and we're good to go, we're going to move forward. It's mainly all eyes are on employment right now, and they're making the customers sign disclosures stating that what they're getting paid isn't affected. And especially with more unemployment reports coming out, this is something you're going to probably see more of.
Wow. So the buyers are going to have to re-verify after going through the entire process. The day of signing, they're going to have their employment re-verified.
Yeah, some of the banks that would net fund and that would basically send the wire with docs that would say, hey, look, you're good to go as soon as we have funding packages back, or as soon as you have signed docs, you're free to fund and record. Many of those banks are basically now stating that you cannot fund unless you get a funding authorization number from us. And that is because the lender is verifying their employment the day of closing.
Oh my gosh. Okay. So you talked about locking loans. So let's, going through the process of getting your loan approved, having your complete documentation submitted to you in the package to go through. So it's actually going to take some time to get to the point where you can lock the loan after they've submitted all the documentation to you. But, when you're out with a realtor and you've got a scenario, you can still give what to the realtor? I mean, what can you help them with so that they can go out and put an offer in on a house?
So I think we're going to see some delays in flexibility right now is when we pre-qualify a loan, or I pre-qualify a customer, and I'm looking at their pay stubs, bank statements, I can run it through automation, and it's basically Fannie Freddie basically saying they're approved based on the circumstance. When I have that with my pay stubs, bank statements, I can actually gather up and write up a pre-qual and give it to a realtor so a realtor can make an offer. Where we're going to see delays is basically going to be on product set. So you have FHA loans, which is insured by HUD, and then you have other loans that are insured that have mortgage insurance, like your Fannie Freddies, your typical conventional type loans. They're all underwritten through an automation of Fannie or Freddie, depending which way you go. But FHA runs what we call a total scorecard separate outside of that ties into your AUS run. But conventional loans that have mortgage insurance require the loan to be underwritten by the mortgage insurance company. So a lot of banks, they give that authority to the underwriters at the bank, and that's what we call delegated. What we're seeing right now is we're seeing a lot of mortgage insurance companies going to the bank saying, we no longer want you to delegate and underwrite for us because we're taking the risk. We're going to insure our own policies. So what we want to have happen is not only you underwrite it as a bank, but now instead of you underwriting it on our behalf as the mortgage insurer, we want you to send it to us. So depending on whether that's a GE, an RMIC, a Radian, whoever the mortgage insurance company is, and what their backlog is where you may see some delays in underwriting initially.
Wow. We talked just briefly about cosigners before we went live today. Are you seeing an increase of cosigners, or have you seen that since the credit guidelines are changing? How does that fit in?
So cosigners, for the most part, I think it's in the philosophy that sometimes people think if I have a cosigner with great credit, it's going to improve my situation. And that's not necessarily the way it works. It does work that way in certain instances when you're driving the debt to income ratio down for conventional buyers. If you have a conventional buyer that doesn't qualify with a lower FICO, adding a co-borrower with a higher FICO with a little bit more income may make that loan approvable. But the main reason people are added onto a loan from a cosigner perspective is usually because they're tight on their debt to income ratio. And we need to bring that down to basically put it more in line so it lessens the layering of risk. So that's something that I've always seen, but I don't see an influx anymore now than what I used to or what I've seen in the past. because the ratios haven't moved. Automation hasn't moved. It's basically you're still looking at it the same way. So the retraction that we're seeing is more of just an availability in space for investors in the secondary market, not necessarily Fannie or Freddie changing the risk factors in automation.
You bring up a point right there. What's changed with the debt to income ratios? Has anything changed or?
No, not that I have seen. I mean, I run automation all day long, pretty much. I mean, automation is one of those things where it's like you have what we call your benchmark ratios, and then you have what basically automation will take, layering of risk. And I haven't seen really much of a change at all from a debt to income ratio perspective. Now, there are products that there is some retraction because from an overlay perspective, so like you may have down payment assistance programs retracting on a max DTI, my community mortgages, you might see, Home Ready's, Home Possible, 3% down conventionals, people starting to max the DTIs on those, even though you have automated approval. So, but these are all investor overlays. So these are not things that, for me to speak to that would be like I'm speaking for every lender in the country, which that's not necessarily the case.
Well, we're right up against the 30 minutes that we said that we were going to do this morning. But we're going to start a series of different seminars each week, try to keep it consistent on the same day and time. Just 30 minutes of your time. It's an opportunity to message me on Facebook if you've got additional questions. We do put it out to the realtors who have been awesome to kind of sit on the sidelines here. We haven't put their videos and whatnot on, but you're a local guy and always available to pass different scenarios through. We talked about going toward the conversation about VA next week. And because you are, I believe, correct me if I'm wrong, aren't you the preferred lender for Fort Huachuca, which is one of our military bases here in Arizona, located in Sierra Vista, and kind of walk through the VA, what they're looking at, what the process is, talk to the realtors about, what that buyer is, what that looks like, and some of the things you do with that. So if you're good with that, we'll put a flyer together and update it, and we'll talk VA next week because it's a great product. And I think from what I hear often from my lenders is sometimes the offer that's a VA can get overlooked. And so maybe you can help us walk through that. But I'm Carrie Sparks with Pioneer Title. And like I said at the beginning, if you have not worked with somebody at Pioneer in a long time and you don't have a relationship, I'd love to be your go-to gal for your title and escrow needs here in Arizona. So my phone number is 602-715-5704. Message me, call me. I'm open for business and excited about our bounce back and in our whole housing situation here. Actually, we haven't really turned off in Arizona. So been hard at work through this whole pandemic. And Brian, if you want to say a couple closing remarks, I appreciate you. Thank you so much.
Yeah, thank you, Carrie, and thank you for putting this together for us. Again, Brian Reeve, Barrett Financial. My phone number is 602-741-4801. If you have anything that you need, any questions, or you have any scenarios, or maybe you have some kind of retraction from some deals that maybe someone that you're currently working with based on overlays or something, it is maybe causing the deal to go south, give me a call. Let me see if I can basically work or save it and try to figure out a way that, I can put things together for you to try to keep those deals live for you. Again, that's 602-741-4801. You can also visit my website. It's www.B as in Bravo, K as in Kilo, R as in Romeo, E as in Echo, E as in Echo, V as in Victor, E as in Echo.com. It's basically initials, last name. And thank you,
Can
Carrie.
you put a copy of your business card down below so that people can reference it? And of course, if anyone does want to get a hold of you with scenarios, I can always help in making that connection. But again, thank you so much to everyone who does use Pioneer Title and works with Brian. We appreciate you and have a beautiful day. And if there's anything that either one of us can do to support you, we're here. But have a fantastic rest of your day and rest of your week. Thank you.